Welcome back to Investing Talk Podcast.
Today, we are looking at American Resources Corporation.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us so we can keep finding these companies for you. Now, American Resources. I have to be honest. When I first saw the ticker, I thought we were going to be talking about, digging coal out of a hillside in Kentucky in 1950. Why on earth are we talking about them today?
You're not entirely wrong about the history. I mean, they do have that legacy infrastructure. But the reason we're doing this is because this isn't really a mining story anymore.
No.
It's a technology play. It's an aggressive pivot into one of the most critical sectors in the global economy right now, critical minerals and rare earth refining.
Rare earths. We hear that buzzword constantly. Everyone knows we need them for EVs, for fighter jets, and everyone knows China controls the supply. It feels like every microcap with a shovel is pivoting to critical minerals these days.
And that is exactly the skepticism you should have. But the stakes here are legitimately high. The U.S. supply chain is, well, it's dangerously dependent on China for these materials.
Right.
American Resources, through their subsidiary ReElement Technologies, is attempting to solve that bottleneck. And they aren't just trying to dig more holes in the ground. They claim to have a fundamentally better way to refine the stuff.
Okay, so the pitch is national security plus the EV boom. I get the narrative. But let's look at the actual business. You mentioned ReElement. Break that down for me, because when I look at the filings, I still see a coal segment called American Infrastructure.
They do, yeah. They still have that legacy coal segment. But if you're buying the stock today, you're not buying it for the coal, you're buying it for ReElement. That is the growth engine.
And the moat.
The moat here, and it's a significant one, is their technology. It's a patented chromatography-based purification platform.
Chromatography. Okay, I remember that from high school chemistry. Dipping filter paper in water and, watching the ink separate into colors.
Yeah.
Are you telling me they're going to fix the national supply chain with filter paper?
That's the basic principle, but imagine it on an industrial high-tech scale. They licensed this from Purdue University. To understand why this is a big deal, you have to understand how the industry works right now.
Go on.
Traditional refining uses something called solvent extraction.
Which is what exactly?
Think of it like a giant, messy chemistry set. You have massive tanks. You mix the ore with harsh chemicals, with acids, let it settle, separate a little bit, and then move it to the next tank. It's a batch process. It's stop and go.
So it's inefficient.
It takes up hundreds of acres, it's incredibly slow, and it produces a horrifying amount of toxic waste. It's the industrial equivalent of traffic gridlock.
Got it.
ReElement's method, the chromatography, is a continuous process. Instead of big mixing tanks, imagine these tall columns. The fluid flows through continuously, and the physics inside the column just separates the rare earths. It's like a highway instead of a traffic jam.
Okay, so it flows better.
Yeah.
But does it actually make money? What are the specs?
So we're looking at research that claims 100 times higher productivity per unit volume.
100 times. Come on, that sounds like marketing fluff.
I know it sounds insane, but it's because of the density. Because you don't need the massive settling ponds and mixing tanks, the physical footprint is tiny.
How tiny?
You can put a refinery in a warehouse instead of needing 500 acres. Plus, it offers an 80% reduction in waste and 70% less carbon emissions. It's cleaner, smaller, and faster.
Which I assume is crucial if you want to build these things in the U.S. or Europe where you can't just, dump acid in the river.
Precisely.
But here's my question. What are they feeding into this machine? Do they have their own mine? Because a great refinery is useless if you don't have the rock.
And that's the beauty of it. The tech is feedstock flexible. They can process lithium ores, sure, but they can also process recycled magnets and battery black mass.
Yes.
That's the industry term for shredded up EV batteries and manufacturing scrap. They're taking waste old batteries, factory garbage, and turning it back into incredibly high purity minerals.
Wow.
Yeah, we're seeing purity levels greater than 99.9% for things like samarium, which is critical for defense applications.
Okay, so they have a magic box that turns trash into treasure. I'm listening. However, I'm the guy who has to look at the bank account. And when I switch to skeptic mode and look at the financials, it's a bit scary. They're effectively pre-revenue on a large scale. They're burning cash.
They're in the capacity ramp phase. You expect cash burn when you're building out infrastructure.
I expect cash burn, sure,
Yeah.
but free cash flow is negative. I mean, they're pouring money into these facilities. If the ramp-up hiccups, they run out of runway.
That's true.
That is the classic microcap death spiral. You build the factory, run out of cash, and go bust.
That's a fair concern, but you have to look at who's stepping in to fill the tank. Look at the funding news from this January, from 2026. This isn't just retail investors throwing money at a dream.
Right. They secured a $200 million strategic equity facility from Transition Equity Partners.
$200 million. That's a serious number for a company of this size.
It's massive, and that capital is specifically earmarked to scale their Marion supersite to over 10,000 metric tons per year. That is the bridge to revenue.
Okay.
And it's not just the private sector. We have to talk about the partnership involving the U.S. Department of War and Vulcan Elements. We're talking about a framework worth $1.4 billion for a domestic supply chain.
The Department of War.
Okay.
That's the heavy hitter here. That signals the government is treating this as a strategic asset, not just some commercial venture.
Exactly. It's like a shield against total failure. And don't forget the $40 million private placement from October 2025. That was at $5.10 per share.
So institutional money is buying in at these levels.
They are. They're betting that the Marion supersite and the Noblesville expansion, which is a 141% capacity increase, are going to come online and start printing money. Okay, so the cash is there for now. The runway's been extended. But, having money and spending it wisely are two very different things.
Yeah.
Let's see how the market is reacting to all these announcements.
Right.
Because if the story's this good, the stock should be flying.
And it has been flying. If you look back from where we are, so late 2025, early 2026, the stock surged nearly 300% year to date.
300%. That is a parabolic move.
It is. The market finally woke up to the narrative. Investors started realizing, okay, this isn't a coal company. It's a critical minerals champion.
But trees don't grow to the sky. And 300% runs. They usually end in tears for the people who buy the top. We saw a pretty sharp pullback in November.
We did.
The stock dropped about 11–12% in a short window.
It did. But we know why. It wasn't a flaw in the tech. It was dilution.
The dirty D word.
They did a $17.32 million share offering.
Which, let's just be clear for everyone listening,
Yeah.
means the company printed more stock to sell for cash. So if you owned 1% of the company, suddenly you own less.
Correct. But you have to ask why they diluted. They
Yeah.
didn't do it to pay the electric bill. They did it to capitalize on the high stock price and fund the factory.
It's the cost of doing business.
It is. It's the double-edged sword.
Right. So right now, looking at the chart, it looks like the stock is trying to build a base. It's digesting that dilution. The psychological state of the market is just wait and see.
I agree.
They're waiting to see if that $200 million funding news is the catalyst that triggers a breakout to retest those highs.
And the volume analysis tells a story of accumulation. The volume is elevated. We're seeing high turnover, but it's driven by these institutional placements. It's not just retail panic selling.
It's shares moving from weak hands to stronger ones.
Potentially.
Okay, speaking of hands, let's talk about who's actually holding the cards.
Yeah.
Moving on to sentiment. Who is buying and selling this story? I like to look at the data, not just the vibes.
Well, the data is interesting here. If we look at the Alpha Vantage data, we have a net sentiment score of roughly
Right.
plus 0.034.
That is barely positive. That's slightly bullish at best. For a stock up 300%, shouldn't sentiment be through the roof?
You'd think so, but it's a tug-of-war. On one side, you have the massively bullish news, right? The 200 million facility, the partnerships. On the other side, you have the bearish news, the dilution, the auditor notes.
So the algorithm is just confused.
Exactly. It's balancing those two realities, and it's confusing the sentiment models because the news flow is so polarized.
Let's talk about the people on the inside. Insider activity is usually the best tell, and I see Golden Properties unloading stock.
Mm-hmm.
They sold about $3.2 million worth between October and December. When a major holder starts cashing out that much, I get nervous.
You should, but context is key here. Yes, $3.2 million is a lot of money,
Yeah.
but Golden Properties still holds over 10.8 million shares.
So they just trimmed the position.
Exactly. They sold into a 300% rally. That looks more like prudent portfolio management, not a lack of conviction.
Fair point. If
Yeah.
I was up 300%, I'd probably buy a boat too.
Right. Taking some chips off the table after a triple is just smart.
What about institutions coming in? That's the other side of the coin.
And this is the stronger signal. The Transition Equity Partners deal is the headline. A $200 million commitment. You just don't write a check that size for a microcap unless you've done serious due diligence.
It's a massive vote of confidence.
It is, and it's not just financial investors. You mentioned Piosco International earlier.
Right, the offtake agreement.
Yeah. Piosco is a major global player. The fact they're signing up to buy what ReElement produces validates the commercial demand. It proves the product is real.
So the smart money's buying, insiders are rebalancing, and the analysts.
TipRanks has a buy rating with a $5 price target. Although I should mention some AI models are flagging valuation concerns, but human analysts seem to see the growth potential.
It sounds promising, but we need to look at the risks. Let's do the bear case. Because as much as I like the idea of American independence in rare earths, this is a risky trade.
It is. So what's keeping you up at night on this one?
Execution risk. Plain and simple. This is the biggest hurdle. ReElement has never operated at commercial scale.
Right.
We're talking about going from a lab, maybe a pilot plant, to a super site, producing over 10,000 tons. Do you know how many things can go wrong when you scale up industrial chemistry by that factor?
It's a significant engineering challenge. Delays are, well, they're common in this industry. If they run into technical snags at the Marion facility, that revenue timeline gets pushed back.
And if the timeline gets pushed back, we run into my second problem. Financial health. Specifically, the going concern warning.
You're referring to the auditor change in November 2025.
Correct. They switched to green growth CPAs, and the notes explicitly mentioned a going concern warning and material weaknesses and internal controls.
Which is a serious flag.
That is auditors speak for. We aren't sure this company can survive the next 12 months without more cash. They have meager revenue per share right now. If the ramp-up fails, the cash burn could be fatal.
That is true. But that's also why the $200 million facility was so critical. It plugs that hole. Without it, the going concern risk is existential. With it, it's a manageable risk.
Manageable, maybe. But at what cost? That brings us back to dilution. Investors are getting diluted to fund this. The pie is getting bigger, but your slice is getting smaller.
That's the cost of deep tech and infrastructure. You have to spend money to build the machine.
And finally, competition. China isn't just going to roll over and let American resources take this market. They dominate this space. And you have larger Western players like MP Materials. Why does little American resources win?
It's a valid risk. China has scale, pricing power. MP Materials has a head start, but American Resources is betting entirely on their tech being superior.
That the chromatography method is that much better.
So much cleaner and more efficient that they can undercut competitors on cost while meeting strict environmental standards. They don't have to beat China on volume immediately. They just have to be the best option for the U.S. supply chain.
So it's a bet on better tech winning out over established scale. A classic innovator's dilemma.
We've weighed the risks and the tech. Let's get to the verdict.
Go ahead, give me the number.
I'm giving American Resources a bullish score of 7.5 to 8 out of 10.
That is pretty high, given the going concern warning.
Yeah.
Justify it.
Here's the thesis. The elevator pitch is simple. This is a pure play on U.S. national security and the EV supply chain. They have the technology. The chromatography is a proven differentiator. They have the partners, the Department of War and PSO are massive validations.
And the cash.
And crucially, they finally have the cash. That $200 million removes the immediate bankruptcy risk and funds the growth. The pieces are finally in place.
But it's a waiting game.
Exactly. You have to be patient. This is a 12 to 24-month hold. You're not buying this for next quarter's earnings. You are waiting for the revenue inflection.
For 2026, when the Marion facility actually turns on.
That's when the repricing happens.
And what's the blue sky scenario if everything goes perfectly?
The blue sky potential is a spinoff. There's been speculation that ReElement could be spun off as a standalone entity. If that happens, the value unlocked could be massive, or they become an acquisition target for a major materials player.
So, in conclusion, it's a high-risk, high-reward play on American industrial independence. You have to stomach the volatility, you have to ignore the terrifying auditor notes, and trust that the chemistry works at scale.
That's the bet.
But if it does, you own a piece of a critical choke point in the 21st century economy.
And with the Department of War backing them, it's a bet I'm willing to watch very, very closely.
It certainly won't be boring. If you enjoyed this breakdown, make sure to subscribe and hit the bell. We'll see you in the next one.